Okay, hello and welcome to episode 4 of the Technical Bootcamp. This week, we are talking about the topic of imbalances. Now, imbalance is a really strong concept that gives you more clarity around market directions and acts as magnet price areas that when you understand how to identify imbalances, you'll be able to find areas the market is likely to be drawn into that before you wouldn't have quite spotted. So in this class, we're going to go through the theory of imbalance, why it happens, how to identify and plot imbalances correctly on the chart, and how to use these correctly plotted imbalances to identify strong entries and targets, avoid premature trades, and make sure the trades you get into are the highest probability and the highest risk reward. So with that said, let's jump into the class. Okay, so a quick warning before we get into this class. This will not make full sense to you unless you've watched my supply and demand and market structure videos, which is episodes 2 and 3 of season 1 of the bootcamp. Okay, so the previous episodes to this. If you haven't watched those, go and watch them now. Then this video will make more sense. If you have, good, you're set up to understand this. Okay, so today, as you know, we're going to talk about imbalance. Now, imbalance, we very briefly covered on in the previous class. It is an open price range between a demand zone or a supply zone, and then where price is currently trading at the end of a leg of price action. Okay, so in the example we have marked on the chart here, our imbalance would be this run in price. It's basically the push from this demand zone, and then the market hasn't retested the demand zone yet. So we have an open price range between these levels, which becomes our imbalance. All right. Now, the way that we generally want to trade imbalance, to give it you from a very surface level view before we go deeper into it, is we want to see imbalances filled. Okay. So we're going to be utilizing imbalance to work out where the market might go to next, which can be used for entries, for example. If we see an uptrending market like this, we have a demand zone open like this, and we've created an imbalance in the market like this, then we see this imbalance as a high probability kind of price range for the market to draw back through to trade towards the demand, where we would then look to take an entry. So when we get into this range, we would be looking to take an entry for a buy, which would take us into new highs. Okay, so that is the first way we use imbalances. When we identify one in line with the direction that we want to trade, we use it to basically await the market's return through the imbalance, and then we buy from there. So it stops us in that right from prematurely entering trades, such as getting into a buy up here. If we see the imbalance is open, we know the best thing we can do is to wait. Now, another use case for imbalance is for targets for trades, okay? So if we take a look at this bit of price action, which obviously, if you watch the previous classes, you'll understand is an uptrend. Well, if we see that, for example, we'll keep it broad for now, but you'll see examples of this on real charts. If we see that prior to this movement, we had a area of supply, let's say, up here, and then we had a big selling move, and then we started to shift that trend to the upside. Well, this whole price range here is actually going to be then imbalanced because we have a supply zone, this one here, that hasn't yet been filled by price on a return into that area. So we can actually utilize this imbalance that we have to take a trade up towards it. All right. So they're also good, not just for entries, but for identifying where to take the market to. So we can use this imbalance here to understand if we want to buy, it's going to be from this point. And then we can use imbalances over to the left, previous imbalances that are still open, as high probability points to target. Because if we know there's an imbalance here, it's very likely that the market will trade through that open price range to fill that area for us to trade from. Okay. So it's basically a way of seeing where the market's going to go next. And we use this information to basically find entries for trade and also to find targets for trades. Okay, so that's what imbalance is all about. Where is the market going next? Now, the theory behind imbalance and why these things work comes down to that battle between buying and selling that we saw previously. Okay. In the supply and demand class and in the market structure class, we discussed how these movements, the pro-trend movements that create breaks of structure and come from areas of supply or demand. So in this case, this is a bullish move. So we come from demand, we have a rally higher breaking the high. This is an impulsive move. And what it indicates, while being an impulsive pro-trend movement that has created a new leg of structure inside of an uptrend, what it indicates is that buying is clearly in control from this point all the way up to the end of the move. We know that buying is in control because the price is appreciated without resistance from sellers. And we know they're in control cleanly because they've pushed through a previous high, again showing that buyers here are stronger than buyers at any other point previous in the range, okay? So we have strong buying and weak selling. Now, when we discussed demand, we said that this was like auction theory, okay? And to explain this to you just real quickly again, all a demand zone is a discount price zone. So it's two price levels, which is basically going to be from the low, 161.52, to the high, 161.61. That is a price range that was seen previously when the buying here took place last time as a very good price to buy this asset. Okay, so we've seen a lot of people saw this as a good price to buy the asset. They bought the asset in massive numbers to the degree that they overwrote any pressure from sellers, and the market went and made a new high. Now this stands true. This is a discount price zone. So with that in mind, and very much like what we discussed in the previous class regarding why demand zones and supply zones get retested, well, we have here an open price range that isn't seen as such a nice price to buy this asset. We know that any buyers would much prefer to buy this from a discount than at the current market prices. So when we create that imbalance by creating the impulsive drive higher, we basically have a good open range here for the market to return through to trade into the discount price area, because that's going to entice buyers a lot more than if, they were to just buy directly at the high at a premium price. So an imbalance is basically just an open price range created by impulsive buying or selling that essentially shows us where the most premium and most discounted price areas are to buy and sell from. So here, this push down created a premium price range that sellers would love to sell at again. Now that we're trading down here, it's less likely that we get significant selling coming in than it is to get significant selling coming in from a premium price level. And then the same on this buy side. Now that we have this impulsive drive higher, proving to us that this was seen as a discount or a fair price to buy the asset, it's much more likely that if we get back to this point, we see massive amounts of buying than it is to see massive amounts of buying at what traders will see as a premium price, okay? So you have to think just behind the scenes of what we're actually seeing in markets. It's more about where is the good price to buy or sell an asset. That is where the high probability and biggest opportunities will come from, because that is where the majority of buying will take place, right? Would you buy a car for $20,000 if there was a good likelihood that you may be able to get it very soon for $12,000? Probably not. You'd wait and see if it returns to that price that you like. And if it does, it comes into that discount price range. Well, now you think, wow, this is a deal. I'm going to buy it up in mass. Okay. And that is what we see in terms of supply and demand in the markets. And that is what imbalances just help us to identify. When we see an open price range, we understand there is a high likelihood at some point in the near future, the market will return through it to trade into a discount or premium price area, also known in this case as demand zone or a supply zone, therefore allowing us to, number one, use those areas as entries, and number two, use those areas as targets, and number three, the final thing, is just simply to avoid taking bad trades, okay? Instead of buying up here, when you understand imbalances, you will almost always be taking your buys down here. Instead of selling down here, when you understand imbalance, you will almost always wait for the market to return to that premium price area, where that bigger, higher risk reward, higher probability short setup can commence, okay? So that is the basic concept of imbalances, why they take place and what they help us to do. With that said, we'll go a little bit deeper into this just now. Okay, so to identify an imbalance, that's the first thing, of course, we need to know. We are looking for simple, open, impulsive price ranges. It can be made up of one candle, it can be made up of multiple candles, but there is a simple rule to identify an imbalance, and we'll go through that just now. Now, the first thing with imbalances is if we are looking at pro-trend imbalances, i.e. this market is in a downtrend, we want to determine which way this market is then going, which in this case, due to this break of structure and the continual formation of lower lows and lower highs, this is a downtrending market. So we would be looking to sell from this market, and we would be looking to sell from supply zones, okay? So we don't look at demand zones in this. We don't look at buys. We look at sells from supply zones. So if you were up to date with the bootcamp so far, you'll understand the supply zones I'd be looking at would really be this one. This is the last candle before an impulsive candle, okay? And then this one here, which is the last candle before the impulse. Now, if you remember what we discussed in supply and demand as well, we know that this one is the extreme zone. So the best way to approach this can be sell limits. The extreme zone is simply, for anyone who does not know or needs a reminder, the furthest zone in the current leg of price action from where price currently is. Okay, so it's like the final supply or demand zone if you're faced with multiple supply or demand zones. So we have this zone here, which obviously in this leg of price action is actually kind of in the discounted area. Not great for selling, to be honest, at this point, but it is still a valid supply zone. And then we have the extreme zone, which is this zone here. And if you take a look previous to this, there is no extra supply zones. They've all been filled, okay? Now you might be thinking, why would this not be a supply zone? And well, that's simply because the imbalance no longer exists, okay? And this is how we begin to identify the imbalances in the market and which zones are good and are bad. So when we are looking at a supply or a demand zone, we want to make sure that it has imbalance into it. If it does not have imbalance into it, it is not something we would look to trade from. So if the market was to return to this top zone, we would not want to sell from there, okay, from inside of this zone, because it's already been hit. So we created supply, we had an impulsive move away, but then the market came back through and we see this wick here. So from this candle and this candle, the wick fills the open impulse that was created. And that would be where the imbalance was. So once this wick has returned to hit this area, there is no longer any imbalance in this supply, okay? If we take a look at the next movement, however, this supply zone, we see that we have a wick here, so this candle. Then we have an impulsive drive lower. And then the next wick is actually here. So that creates, we'll draw it as a box. Here to here is an open imbalance, right? This wick does not fill the gap. This wick does not meet this wick. So the space between there is the imbalance, right? So let's call that IMB. And what we will do is we'll make this gray for now. And we'll just keep in mind that gray boxes will be used to mark imbalance, okay? So with this imbalance remaining, that means this extreme supply zone is still open and still probable to be retested. So if we were looking for a sell from where we are, we have, of course, this imbalance and this extreme zone to consider. Now, the reason that this lower supply as well is still valid is because there is, again, a remaining imbalance. If we take a look at where the wicks meet the wicks, we've got a wick here, we have an impulsive candle, still not filled by the wick, and we have the wicks previous to it, still not filling this wick. Therefore, we have another imbalance, okay? So here we have two supply zones, two imbalances. There's a supply zone up here that's been filled, so that is now written off. We don't focus on that anymore. And what we would do is basically use these imbalances to understand the market is highly probable to come back to retest one of these areas before we sell. Okay. Now, obviously, as we've discussed, we like to sell from premium price areas. With this zone being so close to price, we would be less interested in this one. And with the remaining imbalance that sits above, we still have basically a magnet price area that the market is likely to be drawn through to sell from the extreme zone. So in a case like this, we would heavily focus on the extreme zone and we would focus a lot less so on this lower zone because there's still imbalance remaining into the higher point, the extreme zone, that is likely to basically draw price in like a magnet, okay? So what we're gonna do is now run the market forward, see what happens. You see here, up to this point, we still have imbalance open. Now with these new blue candles, the imbalance is of course shrinking. We are getting closer to the supply zone. But again, we still don't anticipate any notable movements until the full imbalance is filled. So if you've learned ICT, there's a take on imbalances. It's basically imbalances remade to look like a new concept called FVGs, right? It's fair value gaps. The idea with those is you trade out of imbalances. So you would sell like now for some reason. To me, it doesn't really make much logical sense. Kind of goes against what, this whole thing is showing us. But if you trade FVGs or you know FVGs, this is the kind of original way of doing it before FVGs was created to sound smart, okay? So basically, what we're looking for is not a trade out of the imbalance. We are looking for a full fill of the imbalance into there. And then we look for a sell once the zone has been met and when there is no more remaining imbalance. And if we think about why this is, just dial it back to the supply demand class. Supply zones show discount price areas where significant selling has taken place previous, as indicated by the initial impulsive move. So therefore, if we can come back between these two discount, or in this case, premium price levels, we are then likely to see new selling step in from what is seen as a proven premium price to sell from, okay? So the imbalance shrinks with every candle that pushes closer to the zone, but until the zone is fully retested and the imbalance is completely closed, no trading is to be done. So there we go. You can see at this point, just here, this wick, this has filled the remaining imbalance. Now that there is no imbalance, the market is what we call efficient, and we're going to talk about efficient ranges in the next class. But this becomes the point at which you would then want to sell from, because there is no remaining imbalance in this entire leg of price action from the high to the low. Therefore, this is the most probable point for us to make the next leg of bearish price action, which would give us a clean trade from the supply down to the low. Okay, because we are expecting the market to continue the downtrend now that all open imbalance has been filled. So now the price has hit the premium price range, the premium selling area, we then get a new influx of sellers from that area of supply that brings the market to a new low and therefore fills a profitable trade of around 5.6 R. Okay, so that is how we utilize imbalance, or how we identify imbalance. And then we always just have to think about the story behind the market, as we've done here, working out why would we not focus on the lower zone? Why do we focus on this one? Well, that's because the imbalance is large, it's still open. This is the most premium price point in the range. This one, although yes, it is still a valid supply with imbalance, it's more of what we would call an inducement. We'll get into that in liquidity. To explain it simply, it's still kind of a discount price, right? It's a pretty low price in comparison to if we were to see a full reversal and retest of the full higher extreme zone. That's going to be the more premium price area for selling to take place. So there you go. That is a quick visualization of how to mark supply and demand in line with imbalances. To identify imbalance, you're pretty much always going to begin with a supply or a demand zone, which therefore means you need to begin with identifying which way the trend is going. And when you have the supply or demand zone, so just to show you very quickly, when you have that, in this case, supply marked, you are looking for an open price range where wicks do not touch wicks, candle bodies do not touch candle bodies. There is just an open push in price and there is no fill of that just yet. That becomes your imbalance. And then when the imbalance is filled, that is your trigger point to get you into a trade, okay? Now, as you can see, obviously with the imbalances highly probable to be filled, we don't have to just use this for entries. We can also use this for targets. Now, it's more contextual. You don't want to just counter trade everything. But for example, if we were to be given the opportunity to make a buy from here, this becomes a very, very simple target because we see that imbalance above and we know that's likely to be filled, which allows us to take a buy from down there up to that point. And we know for a fact, this is the perfect place to get out of that trade because the imbalance will then be completely filled and redundant. Okay. So in this case, I would say there was no opportunity to make a buy here, but in some opportunities, as you will see, there is room for us to actually buy through imbalance ranges towards open supply or demand zones before we shift that bias and go the other way. Okay, so let's take a look at an example of this in the market then. This is a market that is trending to the upside. Now we're on UJ, so we're kind of into blue skies, really. There isn't too much in the way of using imbalances as targets for this that we would want to do. But if we'd built the bias to buy, and then we saw this pattern in the market, which you'll know as the standard confirmation, basically, we have lower lows and lower highs. We've seen the initial shift into higher highs, basically confirmed here. Now, we haven't seen it confirmed perfectly at this point because of wicks, but when we make this large bullish closure here, we basically have then the understanding that we likely want to buy this market. We use imbalances then to identify the best point for us to actually make these buys from. We can see that this impulsive candle has created a large imbalance between the wick here and then where price is currently trading all the way up here. Okay, so if we want to buy, are we going to market execute from here? Are we going to market execute from here? Are we going to buy up here? No, we are not going to do any of that because we would get a subpar entry. Okay, if we were to place longs there, get into a trade, stop loss would either have to be in an incredibly dangerous location. And by the way, if your stop loss is inside of an imbalance, you're basically asking to get destroyed. So our stop would have to be at a minimum down here and then maybe even under this low. So the risk reward on this is really not going to be all too good. So if we want to kind of get the best possible entry, well, we identify the imbalance and then we take a look at where that's going to lead us into. In this instance, our demand zone is going to be from here through to here. And there is a clear imbalance into this point, which makes this a high probability point for us to then buy from. Now, there is another point as well. If you take a look here, we've actually got some imbalance that leads us into this point. And we could call this one the extreme because this is, of course, the furthest from price. However, in this instance, if we take a look at the size of the imbalance that's been created, we've had a tiny imbalance created at this point. Then we had this kind of reaccumulation, which is a sideways candle, indecision candle with large wicks up and down. Then we had this very clear impulse away. And this is still in what we would classify as a discount price region. You know, it's quite far away from where price is currently trading. So factoring the size of the impulses that have been made, we can see that this zone created the largest impulse. Therefore, this zone saw the highest amount of buying, okay? The highest consideration from buyers, basically. So we could look at this zone as a viable point to buy from. If we wanted to be super safe about this, we would go stops under the low entirely. I would be completely fine with that way of executing trades here. So what this could look like, thanks to the imbalance we've now located, would be a buy here and a stop just under this low. The more aggressive take would be a stop just here, which would be fine. Again, this stop is in an imbalance, but it's from a very notable buying point, which created a massive impulsive push higher. Okay, so that would be okay in most cases. We'll keep it very simplified for here though. And then if you just wanted to look for a, let's call it for our target, why not? If you wanted to look for a 4% return, your trade would look something like this, okay? And what we're doing here is we're seeing basically the shift in structure, which really come through here. And now we are identifying imbalance, which is that open price range, to find the best possible point for us to buy from. And we can factor in here some of those other lessons about momentum and about impulsive moves and the real, true utility behind supply and demand zones, which is that they are showing us areas of significant buying or selling intent. And we can decipher from that this zone is less interesting than this zone because this zone created a much more significant bullish move up. So that would pretty much lock us in with this being our trade setup. And then if we let the market run forward, you'll see exactly why we don't buy here and we wait for those imbalances to be filled. Because as you see there, we have this slow pullback down. And as soon as that area of imbalance is filled and the demand zone is retested, we're back in that discounted price range. And that sets us up with a very nice opportunity to catch a very healthy profit. Now compare that to buying without an understanding of imbalances. If you were buying from the market up here, you're looking at a 1.2% return, whereas buying down here with the safest stop is actually going to be 3.75% return, which is obviously a much healthier trade, almost 3x. So that is how we utilize imbalances to identify where we should and shouldn't be getting into trades. Now we're going to take a look at an example where imbalance, if you don't understand this, can be rather tricky, but if you do, is actually a very, very good, strong thing to know to help you to take good trades and avoid bad ones, okay? So we're looking at basically a downward piece of price action right now. So we'd be looking to sell. If we take a look at from the high of this movement, we have our first supply, which is basically this blue candle. We extend it to the high of the gray candle because of the wick. That's been retested. Then we take a look at the gray candle here. We see a new imbalance formed there. That's been pulled back and retested. Then we have these 2 points. So we have this one, this large indecision candle just here before an impulse away. And then just beneath that, we have this more notable one, which is a more confined indecision candle before a larger, more significant impulse. So taking a look at this one, we had an impulse, but it didn't break any structural points until we created this new supply before we had a very strong bearish impulse down. So of these two zones, if we think about that battle between buying and selling, this one is stronger than this one because this one didn't create any meaningful impulses that broke structure. This just kicked off a small drive before a new consolidation and therefore a more significant impulse. So of these two zones, this would be the one that we would be interested in selling from. Now beneath that we have, and this is where people get caught out, this is the thing I'm showing you, we have a supply zone here, which does have imbalance from it. And people would picture this as a point to sell from. Now this is what we call inducement. We're going to get into inducement later in the series. It's important, but the time is just not right just yet. But you will understand at a base level what this is in just one moment. So we can see an inducement as basically a trap. It's a zone that looks good, but because of things like liquidity and imbalances, it's actually a point that is less likely to create reactions than we would like it to. So because of the imbalance we still have, this one would be more so the true zone that we would want to trade from, okay? This one, no impulsive break, so no interest there. This one, impulsive breakdown, definitely interest here. This one, again, impulsive breakdown, but we see between these two zones, there is this tiny piece of imbalance. And yes, although it's tiny, it still matters, okay? Tiny imbalances are still likely to be filled. And this is where people go wrong because they will see, well, the imbalance is so small, I can ignore it. But you shouldn't ignore tiny imbalances like this because at the end of the day, it is still showing open orders. It's showing an open price range, a gap between where the market is now and where the true impulsive, decisive selling began. So for us on this movement, we would prefer to execute from this point, okay, right? So we'll not worry about the stop. Aggressive stops would go there. Safest, most conservative stops would go up there. Don't worry about that too much. We're just looking at the focal target entry area. And then your entry, rather than going on this zone, so rather than having a trade that looks like this, you would have a trade that looks like this, okay? Or with the more conservative stop if you want to. But the idea is, what we don't want to do is trust this zone and put our stop loss where the imbalance remains. Because with the remaining imbalance, the probability of us trading through that point is still very high, okay? And if you take a look at what happens when we run this market forward, we get a drive up, we take out this trap or inducement zone, we fill that final imbalance, and then we have our significant sell-off. So even though the imbalance is only tiny, it's still absolutely relevant because any open imbalance, be it a tiny one or a large one, is still prone to being filled by the market. And if you start trusting that these small imbalances won't be filled and you start taking trades from this position and you're putting your stop losses in these points, well, you're going to get wicked out or stopped out very lightly before the market runs in your favor. So consider imbalances even if they are small because they are still relevant. Doesn't matter if they're only 1 pip, doesn't matter if they're 100 pips. They're just as relevant as each other. If the imbalance is still there from a core, high probability, impulsive, structure breaking area, then you definitely want to keep that imbalance in mind. It's likely to be filled and you don't want to get caught on the wrong side of it. All right, now let's take a look at one of those examples we said where you can use imbalances as targets. So if we look through this downward move that we have from this point down, we see that basically all of the supply zones that have been created have actually been filled by price. So we have these two here, which have been filled. We then had this huge rally, which has actually started to shift some of the structure to the upside. Now, if we were predominantly bearish on this market, let's say from the daily perspective, and we think that once this market has returned to an imbalance point, it will reverse back to the downside. Well, that sets up opportunity for us to actually trade with the smaller trend, which would be this reversal we've seen, towards a notable point of imbalance. Now, given this huge impulse we've just had and the break of this kind of internal structure, when we consider it to the context of a larger daily downtrend, we would want to identify where the supply zones are previous. So we just look to the left over here and find the core point, which in this case would be this open imbalance, which is the highest imbalance in this price move. And we would say, well, now that we've shifted the structure, maybe we have some opportunity to trade in this new small uptrend towards the higher supply. So because these imbalances are likely to be filled, right? Whether it's near term or long term, we basically can use these imbalances as targets on the way into larger trades. So if we overall think this market's going to go down, we can say, okay, where's the core point that it's likely to come down from? We see there's still some remaining imbalance just here. So we could say the most probable point for this to go short is actually going to be from here. If we then see on the smaller picture, we have some potential uptrend forming with this lower low, lower high, lower low, break into a higher high. We could say, well, if the market returns to our imbalance here, we could potentially trade up towards the imbalance here. And then we could look to trade down from the imbalance there. Okay, so we use big picture context of a daily bearish market, smaller picture context of a 4-hour bullish market, and we say if we think this market's going to return to a core imbalanced area before selling off, we can actually use that as a target in the meantime. So we could look at buying, say from there up to there. Okay, you can go conservative stop under all imbalance or aggressive stop under the near-term imbalance, and you can just run a trade using imbalance as your target because your big picture context says even if this market then reverses bearish, it is highly likely to at least first fill the imbalance supply zone we've got, right? So all we're doing here is basically saying, even though the market may remain bearish, right now in the short term it's bullish and we have this clear open imbalance as a target that we can run the market into. Now, just a small interruption from this class. What you're learning here about technicals is necessary, but technicals alone are not sufficient to get you to where you want to go. If you've been struggling at trading for some time, it's generally not because of what you see on the charts, but more so because of the habits, risk behavior, decision-making under pressure, and self-sabotage patterns that form inside of the way that you operate. These are things that simply don't show up in technical analysis. And I've broken all of this down in literally a 15-minute video. I've been through it without wasting time, making it as efficient as possible to help you understand how systems and things behind the scenes that you can't see on the charts are the things that actually push you to success. So if you want to learn all about this and break out of the losing cycle you've been in for however many months or years that you've been trading, check that out using the link in the description, but watch it after this class so that you absorb the knowledge from this lesson before you go over there. It's definitely worth a watch, and with that said, let's get back to the bootcamp. When we scale that forward, we see, although this was a slow-moving market, that's exactly what happens. We traded into the imbalance demand zone, tapped in, creating the buy opportunity. We use imbalance as a target, the imbalance supply zone. And you see when that imbalance supply zone is then met, the buy would be closed out and you would shift into the short side to follow the bigger picture down. So as well as using imbalances for entries for trades, as we did here, we can also use them for trade targets by targeting imbalanced areas that are likely to be filled on the bigger picture context. We can use short-term buys into selling opportunities, and that alone can become a very good trade. And as you can see, because we use this imbalance as the target, well, this buy gets the perfect exit before the market fully reverses. So Imbalance is a tool that can be used to identify good entries and make sure you don't get into trades too soon, for good targets to make sure you're getting out at the highest probable point, and ultimately just to understand the ultimate flow of the market based on whether we have imbalances above and below, and pairing that with supply and demand and market structure, as we've already been through, to determine where the market reversal points and magnet price areas are likely to be. Markets will be continually drawn towards imbalances. So if you understand where those imbalances are and which way the market is going, you can use them to identify pretty high probability opportunities for trades, okay? So it's entries and targets, and above all, it's magnet price areas. We use imbalances to identify points that, although it might look like it now, are likely to be filled in the near future. And when you understand this, you understand imbalances, you set yourselves into a very good position to continually understand the markets better, have better trading clarity, and catch better opportunities. So with that said, that's the end of this class. I hope this has been valuable. Head over to the link in the description for the trading diagnosis class to see what it is that actually holds you back from winning away from the charts. And other than that, I'll see you in the next episode.